The strategy aims to provide clients with diversified exposure across the breadth of the natural resources sector, including mining, gold, energy and agriculture-related equities. We look to add value through our deep industry expertise, rigorous stock selection process, and our unparalleled access to company management teams. Our experience in this sector allows us to manage the portfolio through the cycle. We believe an active approach is key in identifying winners, as it requires deep, forward-looking insight and a flexible investment style bias.
BlackRock's Natural Resources team is one of the largest dedicated natural resources public equity teams in the world in terms of people and AUM. We have the ability to travel extensively to conduct our own on-the-ground research in order to ensure that the best ideas globally are captured. We're also able to leverage the expertise of the wider BlackRock community, and BlackRock's in-house sophisticated risk management tools ensure risks are deliberate, diversified, and appropriately scaled. We believe that we can add value through our detailed knowledge of resource companies. We're long-standing specialists within the sector and have unparalleled access to industry research and experts, and a valuation approach that is well suited for this sector.
We don't expect commodities and natural resource equities to be immune to weaker global economic growth caused by central banks tightening monetary policy. However, whilst recession risks are elevated for developed market, the world's largest commodity consumer, China, is moving in the opposite direction, reopening following a year or more of lockdowns and a strict zero-COVID policy. Meanwhile, in the longer run, demand for a range of commodities such as copper, lithium and steel is set to be boosted by accelerated adoption of lower carbon technologies like wind and solar. On the supply side, commodity supply is being severely constrained by producers continuing to focus on capital discipline, which follows on from years of underinvestment. This has in part been driven by investor pressure on companies to focus on shareholder returns over production growth, and in part by global decarbonisation efforts disincentivizing investment in the supply of certain commodities. At the same time, geopolitical risk, particularly surrounding Russia and Ukraine, adds further uncertainty to the supply side of the equation. A risk to our positive outlook would be companies reneging on their plans around capital discipline.
Whilst the macroeconomic backdrop is uncertain, we see strong idiosyncratic factors supporting natural resources equity performance over the coming years, and we believe there is lower cyclical risk for this sector than for broader equity markets. Demand for a range of commodities such as copper, lithium and steel is set to be boosted by accelerated adoption of lower carbon technologies like wind and solar. Regulatory support for the energy transition is stronger than ever, with true global buy-in. We see the approval of the Inflation Reduction Act in the US, for example, as a landmark piece of legislation. Despite its name, the bill's major provisions target climate change and aims to boost US independence in clean energy technology. In the energy space, the low-carbon transition has disincentivized investment in the supply of fossil fuels like oil, natural gas and coal. And this has resulted in supply being curtailed at a faster rate than demand has been eroded, and hence we've seen higher prices which we expect to persist. The Russia-Ukraine crisis exacerbates energy supply issues, but the trend was underway many months before February 2022. We expect the current environment to drive growth in free cash flow generation and shareholder returns. In 2023, we expect the transition to a low-carbon economy to emerge as a key theme, where mining companies focus on reducing the greenhouse gas emissions intensity associated with their production. We expect to see a re-rating for the mining companies able to best navigate this and are playing this in the portfolio. In the agriculture sector, improving crop prices look likely to persist and benefit upstream agriculture, whilst we continue to see exciting structural growth opportunities in the nutrition area. Turning to the financial health of natural resources companies, levels of debt have been dramatically cut. And in our view, today natural resources companies have amongst the strongest balance sheets out of all the sectors globally. Meanwhile, the companies continue to trade on attractive valuations in our view, both relative to their history and relative to broader equity markets.
In 2022, the fund returned just under 17%, outperforming its benchmark, the S&P Global Natural Resources Index, which returned just under 10%. At a sector level, stock selection within the energy and mining sectors contributed positively to relative performance. Our underweight exposure to paper and packaging names within the agriculture sector also contributed positively, after this subsector underperformed on the back of broader equity market weakness and the unwind of temporary COVID-related demand. In 2022, our underweight to the oilfield services subsector within the energy space also detracted from relative returns. The oil services companies performed strongly on the increase in oil prices and on evidence of rising demand for oilfield services in the supply chain. We believe markets are not fully efficient, and that through our specialized knowledge and structured investment process, we can find companies that will generate alpha over the long term. We do not believe that broad exposure to a wide universe is optimal, and feel the best way to manage risk and generate returns is through a concentrated and focused portfolio. Risk management is central to the team's portfolio construction process. We monitor portfolio risk using Blackrock's sophisticated risk management tools, and this risk data is also independently monitored by our risk and quantitative analysis division. We maintain an ongoing dialogue with our colleagues in RQA and meet with them regularly to discuss portfolio risk exposures in detail.
The Blackrock Natural Resources team has a long track record of integrating ESG-related risks into its investment. We do this because, as a fiduciary, we incorporate into our firm-wide process all relevant material information, including material information related to sustainability. Our investment view is that doing so will provide better risk-adjusted returns for our clients over the long term. As the world moves towards lower carbon solutions in a bid to tackle climate change, there will be an impact on global commodity demand, and we recognise that this trend could be negative for some commodities and positive for others. For example, there are a number of mined materials which are essential for a lower carbon economy, including copper, lithium, cobalt and nickel. And in the energy sector, it's likely that structural winners will emerge as the energy transition gathers pace. For this reason, as a team, ESG factors have been integral to our investment process for a number of years. ESG analysis is a key part of our investment process, as when an issue arises for a company within the sector, this can lead to a material impact on stakeholders and shareholders. It is therefore essential to understand any potential ESG risks that a company faces in order to ensure that we're comfortable in them maintaining a social license to operate. We assess financial materiality of ESG-related risks via data insights combined with regular company engagement, which allows for deeper investigation of potential issues or opportunities for investments. In addition, we believe that there is a positive correlation between improved ESG outcomes and long-term value creation for all stakeholders in the natural resources space.